What's up, Outliers? Happy Friday. Welcome to the very first iteration of our new live stream. The goal for this stream is to provide a little bit of a continuation of the beginner side, except the main difference is it's not going to be quite as structured in terms of topic over time. I'm going to purposefully bounce around a little bit. And the primary reason for doing one of these is as a stopgap until we get into our next major series, but I want to prioritize and make sure that we have time set aside to do beginner and beginner friendly stuff. So as always, let's see who's hanging out here on a Friday. I see Reese, Kirk, Osanano. I see Lauren Shrejay. I see familiar names. It's great to see everybody. I hope you all had a really, really awesome week. Past week was interesting from a market lens. You can see that I've been looking at Bitcoin a little bit from some of its behavior, which I'm not going to say is confounded me, but I definitely find it intriguing. And across the broad market, there's been a lot of really, really interesting behavior. But you can see that, generally speaking, we are slowly cruising towards all-time highs. This move here is really, really important. But notice what this move looks like in context. Let's zoom this in a little bit. And notice this level here is the one that I was talking about. We very specifically need to get above this, obviously, in order to post a new high. But more importantly, the way that we behave around this prior term high is important in terms of determining a differing trend, which that's what this looks like at this point. Very weak so, but still there. This is a good example. We were talking about this, I want to say yesterday, the day before, where you can have instances where the equity sale volume on the day is actually kind of high, but still have an up day. And yesterday is literally a perfect example, or today is a perfect example of how that can be the case sometimes. A little quirky, but that's how she goes. What I want to do is start with a quiz. And this is a 2-question quiz, because normally when I do more questions, I realize that we don't then have enough time to actually talk about the nuances and concepts. So here's our first quiz question. If a trader wants more Vega exposure, should they go out 30 days to expiration? A. 90 days to expiration? B. 180 days to expiration? C. What do you guys think? Reese says C. What other guesses do we have? You could just throw the corresponding letter in the chat. TCM says C. Brain says B. No one says C. Creme of the crop says A. This is a standard test. There's no talking to the test, meaning you can't reason with the test. You got to pick the best answer that you can find. So that means there isn't situation dependent. It is just pick the best general answer. That's by design this way. TCM says D. That's the best answer so far. Lauren says A. I figured this is actually exactly what I was expecting to see, which is a shotgun blast. Reggie says, does it matter buying versus selling? No, because whether or not you buy or sell, you'll have more Vega exposure in the same spot. Kirk goes with A. All right, this is actually kind of fun. You guys are more split than I thought. All right, let me count. See, 1, 2, 3, 4 for C, 1 for B, 4 for A. So we're literally about tied between C and A. That's fun. That's kind of what I expected to see. Brain says it depends on vol term structure, doesn't it? Not really, no. Technically, no. Right now we have 4 for A, 4 for C, 1. Why did my pen stop? 1 for B, 1 for D. Let's take a look, shall we? Notice how I'm not giving you the answer yet. I want you to see it for yourself, and I will simply be a participant with you. Let's find a spot in here that we can do a thing. This looks good. This looks like a good space to me, as good as any. And let's do term. So we looked at 30, 90, and then what was the last one I said? 180 or something like that. And then let's take a look at delta. Let's take a look at a strike. Well, we'll do 2 versions of this. We'll do one based off of delta. Yeah, this is fine. We'll do a 50 delta because that's where we know extrinsic value is the highest. So we'll get a sense of what that is across. I'm going to move this and we will take a peek. We'll use SPY just because we're in there. So I said 30. I see a 28-day here. And we'll just do a 50 delta call. Our Vega on the 50 delta call is 0.755. On the 90, this one, 50 delta. Oh, there's a 50 on the nose. That's fun. You don't really, that's like the fucking 1111 shit. That's cool. 1.308. And then the 180 here. 50 delta, 1.883. Right. You heard it here first. Create a plot. We don't need to plot delta. What do we see? What do you guys see? Where is Vega the highest? C, 180, 180, okay? So then what answer does that give us? C. Vega is higher as you go further out, bar none. That's just how it works. The reason why I asked this question is because I expected a lot of people to get a little bit tripped up in terms of different ways that you can value this. Kirk says Vega as a percent of premium would show different results. Let's take a look. It's a good science experiment. So now let's add premium. Because as you know, Kirk, this is actually one of my favorite lenses to use, is to normalize off of premium. And let's go, we're out here at the 180. So let's take a look at these to start. I'm going to call that 27.7. And then we'll go back into the 90s. Those are 1828. 1828. Fuck, I keep hitting 2. And then let's go to the 30 days. That gives us now let's take a look at our new lens as well. So this will be Vega to premium as a percentage, the good old VIP percentage. And let's see what we see. Exactly what Kirk would expect to see, which is good. What this means is as you get closer in time, you'll actually find this for pretty much all the Greeks. This is how the majority of them behave with respect to time. If you think of any sort of time series based view of options, and let's say that this is 0 DTE, let's say that this is 180. Where is gamma the highest relative to your premium? Here. It's higher there. Where is theta highest relative to your premium? Here. Where is vega highest to your relative premium? Here. Why is this? It's for a really, really intuitive reason. As you get closer in time, options have to do a lot of stuff. They have to make a lot of decisions. And this is actually where the Greeks become amplified as you get closer to expiration. This is also why, as you go further out in time, options behave more like stock replacement. Now, again, there's relative nuance to all of this, which is exactly why I wanted to use this as an example. Because when we talk about where is Vega the highest, Vega is always the highest as you go this direction, every single time, no matter what, period. Yet, the way that volatility changes across the curve is also very different. You can have instances where the total Vega impact can absolutely, and frequently does, favor the front. Even though it has a lower Vega, its total volatility impact can most certainly be pretty high. Easy for that to occur. The reason why these little tests and getting your brain used to thinking of options this way is the more you can frame stuff like this, the easier you can make good decisions because you understand how the things behave relative to your expectations. Because there was another comment about whether or not we're in contango or backwardation, which, funny enough, that actually doesn't matter. Because if we look at a term structure here, and we say that this instead is volatility, and let's say that this is 30-day and then 60-day, and let's say 30-day is here and 60-day is here. So here we're in contango with respect to where we would anticipate vol being. This variance doesn't inherently mean that Vega is higher here. Actually, more frequently than not, it won't be higher here. More often than not, Vega as a number will still be higher here. Not always, but very frequently will be so. And that is very simply to do with one factor. These have way less time premium. These still have more time value. So even though vol might be slightly higher here than here, it doesn't inherently mean that Vega will be higher here because it's working with less overall extrinsic value. And extrinsic value is where your volatility lives. It's not intrinsic. Intrinsic is simply how far an option is in the money. It's in your extrinsic value. And you have less of that here compared to here. So it was a good thought process for people to go through for sure. But that's why whether or not you're in contango or backwardation, backwardation here. I think I said contango before, sorry. It doesn't matter which of those circumstances that you're in. Now, we have one more question. What does skew tell us? How expensive vol is, how volatility is priced relative to different expirations, volatility levels compared across strikes. A, B, or C. What do you guys think? I just crushed a Waterloo tropical fruit, super good. And now I'm moving on to a mango orange spindrift, which these are a fave. No guesses so far? Are all you guys cheating right now? I know the latency ain't that bad. BCC. CCCCC. B. B and C were a toss-up. That's fair. This, realistically, is just a nomenclature thing. It doesn't really matter. So this one, I want to talk about it just because it opens up an important conversation of volatility. But if I was like working with somebody and they were like, yeah, the skew is this, and I knew that they were talking about something else, I wouldn't give a fuck. It doesn't matter. There are some things you will find I am extremely pedantic about. And more often than not, it genuinely is for a reason. Sometimes it's not, admittedly so, but more often than not, it's for a reason when I'm like very specific about terminology. But on something like this, it really doesn't matter, because when you're talking to somebody, if they understand the terms, they will understand the context and what you're inferring. Let's take a look at two things. Actually, this would be a little more fun to plot. Give me one sec. I think this will be more fun to do in here. I'm going to move this again. And let's create a slightly different plot. I'm going to do a 25 delta, 50 delta, 75 delta. And then I'm going to do 10 days, 30 days, 60 days. Actually, no, we'll do 10, 30. Fuck, I don't want the gaps to be that big. I'll just do 30 again. 30, 60, 90, that's good. I don't want to skew it too much because of the raw size of the gaps. 30, 60, 90, 120. That's good. What I'm going to do now is take a look at the implied volatility. Let's start with the 30 days to expiration, which we're in, and we'll do the out of the money options only. So we'll do 25 delta puts, 50 delta calls, 25 delta calls. So the 25 delta puts vol here is 25.9. 50 delta, 48.3. 25 delta call, 24.5. And I'm just going to do 30, 60, 90 versus the 120 as well. I think you guys will see it with the 3x3. 60 days, 25 delta put, 16.97. 80 delta call, 47.8, 25 delta, 23.35%. And one more for the 90s. Here. I'm gonna have to add strikes, yeah. 25 delta. Fuck. Eyes fucked up. 27. 27.72%. 50 delta. 47.4%. Last one. 25 out of the monies. Puts us here. We get 23.4. All right. We have our data. Now let's do an experiment. I'm actually really curious how this is going to attempt to chart it. Yeah, I figured that it might struggle a little bit. We want 94. There you go. Guess what you're looking at here. What is this? X 94 to 97. We don't want that as a plot. I don't like that one. There we go. This is a vol surface. It's exactly what you're looking at. When I pull this up in Thinkorswim, it is the exact same thing that you're looking at. We have two different things that we can measure. Three, technically. We can measure volatility across terms. We can measure volatility across strikes. And we can measure volatility across strikes and terms. When we're looking at skew, again, pedantically, but skew technically is within a term. So what that looks like in this scenario is this specific, let's say 90 delta or 90 DTE. I wish you could highlight it. That would be nice if you like hovered over and you can highlight it, but it doesn't let you. Let me see. I'm going to change the scale just a little bit so that maybe a little easier to see. Yeah, okay, that's fine. Just the yellow kind of fucking disappears on you. There you go. That's way better. This gives you relative volatility in a couple different ways. It gives you relative volatility across the strikes within an expiration, across the strikes in different expirations, and then across the expirations themselves. When we're referring to skew, that's like looking at the individual lines, the 30 DTE, the 60, or the 90, and just looking at how the vol changes across the curve of a single term. And when we're talking about across terms, that's term structure, which probably tells you a little bit of like mental association. Term structure is across expirations. More importantly, again, than the words genuinely don't matter that much. Realistically, a lot of times you'll actually hear traders just refer to it as a skew. And then you just know in the context of the conversation if it's within a term or across terms. But you can learn a lot from something like skew. Let's take a look at SPY And let's take a look at vol. I'm going to look at out of the monies. The reason why we just look at out of the monies is because we don't really care about the in the money options. Their vols are going to be slightly, I was trying to think of a different word, but skewed. So we use the out of the monies when we're looking at stuff like this. This is a useful visual. Now, the downside with a visual like this is you can kind of get lost, and unfortunately, Thinkorswim doesn't let you scale this that well, which is kind of annoying, if I'm being honest with you. I really would like it if you could like limit strikes and stuff. That would be a great version of this tool so that you can explore stuff. Because right now, what's happening is the 19Ds, these insanely far out of the money puts, which are always going to have massively high vol, are just crushing any relative difference that you can see between these. So if I get rid of that, you'll see these come more alive and you'll get a little more context. That's also why, realistically speaking, I use tools. I don't have it pulled up right now, but there's a few of them I use. And again, full disclosure, I'm an affiliate for, I think, all the ones I'm going to show you. They're not paying for me to promote any of this. I literally just use them. So this one is good. I like this one because it lets you view vol in a bunch of different ways. So you can look at the smile, which is just a term that we use to describe skew. More often than not, vol will have a smile, a smirk, and that's just the relationship that you see here. That's all. So this is one way that you can visualize it really in a bunch of different manners. They even have a vol surface, which I actually think is pretty cool that they do this to turn it into 3D. The reason why I like this is, again, because you can get rid of the strikes that you don't want to see. So you can focus on the strikes that matter to you. So let's say that you're doing like 20% up and down from spot price. You can meaningfully drag these in so that you can see what's more relevant to what you're attempting to trade. And let's say that you're not interested going 700 days out. Let's say that you want to know what the structure looks like in a much nearer term window, maybe like within 100 days. It's just because it's what this picked up. You can literally get a sense of where vol is cheap, which is clearly right here. And then you can get a clear sense of where vol is very elevated. And this is, again, just a way to visualize volatility. Another tool that I told you guys I just started working a little more closely with Chris from Moon Tower, and I'm trying to actually help him a little bit with the tool. His tool is really cool, but I would be absolutely shocked if it doesn't have SPY. Let's see. Yeah, I was going to say that just doesn't make sense. So his tool is, again, giving you a different way to visualize that very same thing. This is just looking at the difference in changes in vol. So in this case, this is showing you a ratio between deltas and time. And then you can just look at how vol actually changed in terms of clicks, meaning like individual increments. Then you can visualize the term structure using 50 delta options. And then it's just showing you the spread between that expiration and whatever other expiration you're looking at. So in this case, we're looking at the 10 Ds to the 15 Ds. And we're comparing the 50 delta option in 10 Ds to 15 Ds. And again, to give you an intuitive understanding, this is giving you 11.7. So let's just take a quick look together. Let's go to, I have had 8 concussions, so I already forgot the expirations, 10 Ds and 15 Ds. There's 15, there's 10. Let's go to something close to a 50 delta. That's going to give you like 10.4. So we'll log that down. 10.4 4%. And then let's go out to the 15. Again, the 50 delta is in here. It's like 11.5, we'll call it. So now the question is, well, what? Oh, shit. The question is, well, what is 11.7? That's literally just the difference between these as a percentage. It's giving you a sense of how different the skew is. So when we see this, we can immediately tell that the back is at a premium to the front, which is standard. We would expect to see that. But then something like this tool you would use to spot differences and gaps and shit like that. You can also visualize the skew in different time frames for different days to expiration options. So you can change like the look back period. This one I actually really like. This is probably one of the coolest parts of this by far, I think, is the realized versus risk premium. So anyways, this is another way you can visualize it. And then another tool that does this is ORATs. I'll show you theirs. Here's what I'm doing. I'm just literally showing you all different ways that you can visualize vol, which is a really, really big part of what you do when you're trading options, whether you fully realize it or not. So in this case, you can plot it a couple different ways. I normally would just look inside the options chain. It's a little bit easier. So in this case, it's literally, again, just plotting the vols. And it's giving you the vols. This is a vol surface. It's just a slightly different format because we have our vols here, and then we have our dates as the x-axis. So now you can go through here and, again, play the game of look for stuff that you're interested in. The reason why all this vol stuff is really, really important is because with respect to trading, and when you become a just more savvy options trader, whether or not you choose to like really focus on vol, somebody that obviously really focuses on vol that you guys have heard a lot is Ewan Sinclair. He clearly focuses on vol full stop. But that's not the only way to trade. And I include vol heavily as part of what I do, but it's not the only thing I do. The reason for that is you're never going to get astronomically good returns with vol, and that's trading short vol. Long vol you have a better chance at. So in this context, I'm specifically referring to short vol, which is just trading different discrepancies across the term structure. Well, really, I should say across the surface. And a good example of what that can look like is if you paper trade this stuff for a while, again, even if you just paper trade earnings for a quarter and get a sense of how those tend to behave, you'll get a pretty good idea of what longer term performance might look like for you with short vol. And if I were to just take put a random number on it, and again, take this with a grain of salt, but it's likely generally accurate, I would say anywhere from like 18 to 35-ish% per year, I think is very reasonable for a short vol book. Now, the downside to that is that you miss a lot of the upside years. Like I've already told you guys, this year, I'm on track for my third best year. And my last AAR update that I shared with you guys, the portfolio was up 78.9%, 85 technically, 78.85% on the year. Like that's not going to happen with a short vol. You're just not going to get there. Part of that comes down to what do you like to do and how effective are you at doing whatever the specific thing is that you're doing. One of the most common misunderstandings with trading short vol is like just going out in the market, finding stuff with high implied volatility percentile and selling vol. That is not good. I'll repeat that. That is not good. And I think that confuses a lot of tasty traders, unfortunately, because a lot of tasty traders are used to that approach. The reason why that's not a good approach is that a lot of times you're actually going to sell vol that's not priced well. And you are taking asymmetric risk. You have to pay attention to that asymmetric risk. When you're selling vol, you have a defined profit. And if you're doing it in a pure sense, you have undefined risk. If you do it with defined risk, now you're really, really diminishing how much money you can make in total by a lot. Not even like a little, by a lot, a whole lot. A good example of that is in like the 0DTE stuff that I do. Naked versus not, it literally annualizes 8 to 12% difference. It's massive. And that's because if you want to sell vol, but you also want to protect yourself, which again, it's a logical thought, but who wouldn't do that? You could just sell vol and protect yourself and make a bunch of money doing it. Who the fuck wouldn't do that? That's the point. It's not quite built that way, and it's because markets are generally efficient. So anyways, these are just a few different ways to view vol. Now, let's tie these to tradable concepts. That's mostly what I'm interested with respect to the quiz. And then I want to talk a little bit about the rest of the topic for the day, which is like scanning for ideas, which again, this second part is part of that. This is fundamental knowledge that you have to know. You have to know this because if you're trading just about anything, you want to understand the risk that you're taking and how what you're trading behaves. Without that, you find yourself in this circumstance where you put something on and shit starts moving and you don't know why, or you're confused and it doesn't make sense. This is the very stereotypical, if you buy a call, the option goes in your direction and you lose money. That's, again, typically attributable to some combination of vol and theta. But that can confuse people because you can say to yourself, well, shit, it literally did the direction thing that I wanted it to do. Why did I get fucked up? Which leads to a couple very key takeaways. The first one, if I'm putting on an option, trade, long or short, and I want to increase my overall volatility exposure, there's two important things. There's Vega, which is how sensitive our position is to vol, but then there's also the term and how much the term vol tends to change. A great example of that is here. If we take a look at how vol has changed across these different terms, it looks very different. If we look at the 7-day vol, for example, it went from 24 down to 9. And it did that over a few days. Over that same move, 30-day vol went from 22 to 15, and 60-day vol went from 20 to 15.7. What this is telling you is you absolutely are finding yourself responding differently, your position, to how your vol is behaving. Black Mama says $200 credit spread with 40 delta is equal to hold on, I'm fucking already lost. A $200 credit spread with 40 delta what? Wings? Is equal to a $50 spread for delta 10. Sorry, I'm not totally following. But what I can guarantee you is that last statement that you're making is wrong, which is reduced risk, reduced significantly without giving up any profit. That's not a scenario. What you might mean is that you're not giving up a lot of profit. And unfortunately, you're probably giving up more than you think. But there is no scenario where you're not going to give up any profit. If you're doing any sort of spread, you are immediately giving up profit, period. And it's not just profit in the credit you receive, which also confuses traders a lot. It's also through where you get your fills, especially if you're not legging in. Even if you are legging in, you're now transacting 2 times more. And that's if you're only transacting on entries and then going to expiration. Black Mama says, 200 equals 50 by 4. Can you explain that concept? Sorry, Do you mean $200 wide of a credit spread versus $50 wide and doing 4 of those? Because the delta part confused me. I think instead of selling 4 10 delta for $50 each versus 1 40 delta for $200. Well, now I'm super confused because that's y'all got my fucking head in a blender now. Black Mamba, if you could, no one says, where am I? That's a great question. I'm trying to figure it out too. Black Mamba, if you could just give like an example of the spreads that you're comparing, that would, because Kirk says a 10 delta put could be 50, sell 4, that's 200. Yeah, but that's not a credit spread. Or you mean buying the 10 delta? He's talking naked, not spreads. Oh, Jesus Christ. That's like a massively important piece of that statement. Kirk, shout out to you. I don't know how the fuck you're able to decipher that, but shout out to you. That's like we'll call you the trade whisperer. It's actually funny. I was talking with a extremely seasoned options trader this week, just a friend of mine. And he's on the institutional side. He has spent very, very little time on the retail side. And I was talking to him about some different stuff. And I had brought up the wheel and how the wheel is like really, really common for retail traders. He's been trading options for 35 years. Maybe, well, I think it's more like 38, but well over how long I've been alive. And he literally, I was just like, I brought up the wheel. He literally was just like, what the fuck's the wheel? I thought that was the funniest thing on earth because it just shows how different we're talking here. Like the difference between what retail traders are doing, thinking, and looking at versus institutions. I thought that was super, super funny. All right. Black Mama says, instead of selling SPX 0 DTE, 6850, 6860 credit spread, 40 delta. Okay. So we are talking spreads. Yeah, I literally, I thought the same thing you guys did. I was just chuckling. It didn't surprise me in the least, but I thought it was so funny. He literally was just like, what the fuck is that? And I was like, yeah, dude, that's what I'm fucking working with here is I am trying to bridge that gap, which is difficult to say the least, especially for like the retail side. Obviously, I explained it to him. It was actually hilarious. His response when I explained it to him is just like, people think that's a strategy, which is hilarious. But yeah. Okay. So Black Mom says, why won't a trader sell 68.80, 68.90 for $50 wide, 10 delta, 10% probability? 68.50. Let's take a quick look in SPX, just so that I can try to visualize what you're talking about. In a nutshell, what I can tell you this is going to be a factor is in terms of how much money you're making. That's pretty much it. Let's do, well, we can't do 0 DTEs because none of them here. Black Mama says, please explain the difference to an institutional trader, please. Yeah. Oh, okay. Black Mama says, just an example. Don't have the chain. Okay, that's super helpful. Thank you. Okay, so I think I'm following better now. What effectively I'm seeing is, I understand now. Well, you're taking way more risk. That's why. If you put on one of the 68.50, 68.60, so a $10 wide spread. I mean, we could use the 3 days for this. This will be easy enough. And you said 40 delta. You could pick your delta. So here's your vertical spread. You're $10 wide, and you're collecting 275. So 10 points wide means you're risking 725. That's your total risk on this trade. If you do that other scenario at the 10 delta, so the 6805 to the 6875, you're risking 10 bucks, but you're making 60 cents. So now your risk is up to $9.40. That's for a one lot. Your scenario is saying, why wouldn't we do 4 of those to get the same amount of money? Now your total risk is $9.40 times 4 compared to the total risk in this one, which is 7 and change. That's the difference. It's a completely different amount of risk that you're taking. Black Mama says agreed, but where comes the probability? You mean in terms of what? What we would expect is this one out here that's super far out of the money is to win a whole bunch. This is the very, very standard super high win rate strategy. But you just need one losing trade and then you wipe out how many wins, right? So let's just do the math on that. We said that you're making 60 bucks, but you're risking 940. So what is it? 6.4 times. If you lose once, you get rid of 6. That's the reason. Now let's go back to a 0 DTE in here and let's see what the deltas are all shit. Damn it. Kind of annoying. I was hopeful that the deltas would at least be okay. Okay, these kind of look normal. Yeah, the deltas are all fucked up. That ends up being the rub though. That's the drawback to it. That is the quintessential very high probability strategy, but if you're wrong a few times, you undo all the wins. And that's where timing becomes important with that kind of stuff if you have a good way to sample volatility and whatnot. I want to talk now a little bit about, for the last few minutes, I want to talk about actually, I think we should just stay on vol at this point, just because we're kind of fucking deep in here, boys. We've been on this vol stuff for a hot minute, so we'll just stick on volatility. A little bit of a catfish, but just going where it follows. Black Mama says, I'm trying to build a statistical thesis. If we run this type daily, even if you get caught in the wins, should mitigate losses. Yeah, it's the kind of thing that you would ultimately have to test and see what you get. My instinct is that it would underperform. It would probably underperform pretty significantly. Let me take a look really quick. I literally have a couple tools running right now that I can ask it to do a super quick comparison for us. Let's do like just 30 delta short. And this will be in SPX from when dailies were launched until yesterday. There's some other small details, but it doesn't really matter for the comparison. So this is looking at just a 30 delta short strangle. The compound annual growth rate from 2022, May 16th, which is when dailies were launched until now, is 5.3%. And on these, let's add wings. Let's turn it into a vertical. So now I'm doing 30 delta short wings, or I'm sorry, 30 delta short for the base, buying 20 delta wings. Remember, our compound annual growth rate for the first was 5 and change. Our compound annual growth rate now goes to 2.6. And let's take a look at the super far out of the money stuff. So you said 10 delta and doing 10 strikes wide. Let's start there before we scale anything. And let's see what this does to us. 0.6% compound annual growth rate with really bad drawdowns. Really, really bad drawdowns. The drawdown in this is much worse than the others on a relative basis. And when I say relative, it's relative to how much you're making. Your best year with this from start was in 2023 with a 0.83% return. So very little. Black Mama says Delta 1040, 1.5% by ATR wins. I ran a few tests this on Jesse AI. Yeah, I mean, if you trust whatever that thing is, I haven't used it. So if you trust it, then paper trade it for a while and see how it works. But I know I absolutely trust my tool because I built it. Mama says, can you share the screen? I cannot. I won't. There's way too much specific details in the tool itself that I use. So I wouldn't share it, unfortunately. I wouldn't want to give up some of the secret sauce there, sorry. But yeah, if you think that the Jesse AI thing, whatever that is, if you think that's good and you trust what you're seeing, then in that scenario, what I would do is just paper trade it a little bit and see what you think, right? And see if it logically makes sense. But what we know is as a base approach, it's going to underperform meaningfully, very meaningfully. And we would expect it to, right? The reason why we would expect it to is because no matter what, if you have something that wins a lot, there's a cost to that thing. There's always going to be a cost to that thing because you're going to win a lot. That's the benefit. There is no have your cake, eat it too. If we think of Black Mama says, I agree the returns are not good enough to run it on algo. Oh, I mean, it would probably net lose. The versions that I just looked at there, I don't have any friction component to it. So that's assuming you get good fills and that's assuming you take it to expiration. As soon as you start adding any of that in, I mean, you're immediately looking pretty ugly to start, if even positive at all. So yeah, I think with that kind of thing, the best approach you could do is see if maybe you can add some filters that logically make sense to yourself. But you have to strike a really careful balance because you don't want to get rid of too many samples. If you do that, then you're effectively dismantling the strategy. That's a really big part of trading any sort of more process-based vol type strategies like that. Very delicate balance. Doable, but definitely delicate balance. Any other questions on that? It's a good conversation, at least. I think the biggest thing for you there is paper trading it realistically and getting a sense of how it behaves. Mamba says, I'll back test maybe a fly. Yeah. Yeah, and that's a good way to do it, right? Tinker with different setups and stuff. The reality is, if you move that far out, you're going to really struggle to make any money. One of the biggest pieces of advice that I could give you is when you're testing, try different spots on the curve. There's just not a lot to make out there. And your returns at that point become really, really, really path dependent. Do you happen to get a good path, or do you happen to get a bad path? So what that means is the performance of the strategy comes way less down to the skill of the operator or how well built the strategy is. And instead, we're effectively relying on luck. How lucky are we in terms of how the market happens to behave? Generally speaking, slightly less advised, I think, than something that's a little bit more robust. At least the way I think about it. Sweet. Well, this is a super fun conversation on vol. If you guys have anything else related to vol that you want to explore, throw it in the chat. Still got a few minutes. And then if not, just let me know. But yeah, the cool part specifically to keep in mind when we're talking about vol is that it is a part of every single trade you do, no matter what, always. And there are ways that you can mitigate it if you want to minimize how much vol or how much the other Greeks affect your options trade, or the inverse. You can pick things that purposefully have more exposure based on ultimately what you're attempting to target. The piece I think that catches a lot of traders is specifically not aligning any sort of view of term volatility behavior against the term that they're trading. That I think is completely foregone and leads to a lot of people being upset because they don't know how much the term that they're trading is compared to what position they have. There's an easy way, by the way, to fix that. You don't even have to pay for fancy tools. One of the easiest ways to fix that is measure something like the previous moves. So if I look at the price performance, or even better, the average true range, average daily range, any combination of any of these, specifically the true range, day range would be better places to start. If I look in there and I eyeball how much something is moving, that'll give me an intuitive sense for volatility relative to time. And I'll give you an example of what this means. If I look across a 5-day period, the daily range is 0.6. True range would be better because volatility does care about overnight. For a 5-day period, true range is 0.7%. If we go all the way out to 20 days, 20 days compared to 5 trading days is 4 times. Notice how the range is not 4 times. The difference, the variance in this duration. That's telling you a lot. That's giving you a relative understanding of how volatile the 5 period is against the 20 period. Now, again, this is historic. This is backwards looking. So you have to make a couple general assumptions, like, is volatility in S&P priced pretty close to fair? And the answer to that is yes. So then you can make an inference that implied vol would be priced a little heavier in the front relative than the further back terms based on how much of these pieces. And the broader factor when you're trying to at least have an understanding of the vol and how the vol is behaving against the term that you're in is just so that you don't find yourself buying like really expensive vols or unwinding stuff that you don't specifically want that risk to at that time. You can isolate things pretty well if you want. Some ways you can isolate vol and isolate other stuff realistically. If you want to decrease what your overall vol risk is you can go further out in time and you can go further in or out of the money. Because if we plot Vega across the term, within a term, you'll see that vol will be pretty low when, well, we'll use the out of the money stuff. It also depends on if there's put skew or call skew. If we go out 195 days, you'll see vol is high when we're at the money. It's because there's the most extrinsic value. Then if we go further out, we see vol tends to collapse. Sometimes it'll start to peak up pretty well at the tails. But the other thing to keep in mind is that the vol relative to the premium here is astronomically high. Now, where this always starts to change in big indices is on the put side. The reason why the put side you'll see vols going up is that, I mean, that's why there's put skew so dominant in the indices, and it's because of hedging activity. Lots of people are coming in there relatively price insensitive, willing to overpay. And there's absolutely folks that are willing to sell, but they're going to take their pound of flesh. And it's for the same reasons we were talking about before. Somebody is willing to sell this 5 delta option at the 500 that's 195 days out. The thing with this is that it is a really, really high probability. But let's just take a look at what this thing will look like in a few different scenarios. Let's say that S&P goes down to 400. On this one lot that the trader was trying to make 383 bucks, they're going to lose 10 grand, which you might say, well, that's it going all the way down to 400, which is true. It's a huge drop. But that's the point. That's tail risk. Is the probability of it happening is quite low, but the compensation that you're getting for it is not good. That's how it goes. Finn says, do you have 3 words that best describe your love life? I have an awesome wife. So have awesome wife. Bam. There you go. Osanano says, do you use volatility skew as a decision criteria for short straddle versus strangle when trading earnings? No. The skew itself doesn't really matter that much around actually placing like a systematic based vol strategy. But the way that I trade earnings can be informed by the skew. There's a lot of information you can derive from skew. That part, it takes a little while to develop the intuitive understanding for it. But when you do, it's actually like really, really useful in terms of finding some level of opportunity and stuff. The downside, the broader downside at least, is you really have to come up with or have to develop a pretty well-defined methodology for analyzing skew. Otherwise, you can find yourself like chasing ghosts pretty easily. And what I mean by that is just being in stuff that doesn't work the way that you want. Very, very easy. Black Mama says it's unreal. Is it even probable? SPY to 400. It's 25% down. As options traders, should we even think about this extreme? Definitely. You have to think about that extreme. That's like that kind of extreme is tail risk. Like that is tail risk in a nutshell. One of the most important factors to keep in mind is that the worst day for us as traders is ahead of us. That means like the biggest market collapse is still probably ahead of us, but we just haven't seen it yet. There can be pretty profound moves in terms of a size over short durations. And that's what causes those kinds of positions strife. So yeah, you absolutely want to consider those kinds of moves, even though they're improbable if you're playing in the tails, because that's the risk that you're fighting against. You're not really fighting against much Greek risk because you're so far out of the money. You're not fighting against standard moves because you're so far out of the money. That risk in the tails is the risk that a tail trader is managing. And there's ways to manage the risk. But again, the crux there is that most people, when you trade for a while, you'll find that how much you're making for that risk isn't that attractive as a risk reward profile. And it's just because, again, like, let's just take a look at that one scenario. That was, what was it? It was let's just call it $325 and losing 10 grand. So you can see, like, really, really fast how that becomes a not ideal risk reward profile. You're really facing a significant multiple, like 31 times. So yeah, that's definitely the risk that you're looking at. Kirk says, like a Russell Iron Condor tail risk, the unrealized P&L is harder mentally than a quick binary event. That definitely is, and I have a feeling I know why you're using that example. And it's accurate. The other thing is just in terms of like an expectation, right? Because if we're not at least acknowledging what might happen, then if something even tangentially related does happen, you kind of find yourself completely off guard and not ready to make some sort of good decision around that thing. Let's just use this scenario and say that the trader's account size is $10,000 and they think that the probability of them losing their entire account on this one trade to make $320 is super low, and it is, until that risk is realized. I think the main issue for people there is, like, there's a lot of survivorship bias in the markets. And especially people from like the GameStop community, that's a big one. Because if you think about what the cat did, Roaring Kitty, it's magnificent. There's a couple very key things that he did, I think, that ultimately enabled him. One of them is he was using a YOLO account, right? He was playing with a smaller amount of money that he was comfortable risking wholeheartedly compared to a lot of traders who aren't doing that. And unfortunately, they're trading like real money. And that's no good. The other thing is there were a series of very fortunate events that, coupled with his disposition, led to the outcome, which means that there's luck involved. And it's not an insignificant amount of luck. I've tried to quantify the luck aspect of my trading, and it's very difficult, very, very difficult to actually isolate like what I would attribute to luck, which is, again, like what happens to happen. But it's noticeable. Like, there is a metric, I can see it every single year. I call it the luck metric to just have an idea. I know it's not accurate, but it gives me a sense of what it is. And there's no shortage of luck that went into what happened for him. And if somebody is curious how that could be, just think about how many thousands and tens of thousands of other people tried to do and replicate some of what he did. And you've only heard of one person that came out of that almost a fucking billionaire, which is crazy. It's really, 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 really improbable. Osanano says there's interesting studies about the overstatement of skill versus luck. Yeah, definitely. And it's important to acknowledge, I think, even when you're trading. And I mean, the reality is most newer traders completely fuck that up. Like, bar none. They will absolutely over attribute stuff, which is just a really, really common behavior. It's manageable, but it's difficult to manage because, especially as a newer trader, you really don't know what you don't know. So that becomes challenging to navigate through that, but it's definitely navigable. Yeah. Awesome. Time for me to hop off. great hanging out. We will have our meme stock live stream tomorrow to see what kind of is high flying out there, stuff that's super mobile. So looking forward to seeing whoever comes out there that feels like it. And the next Pro Plus workshop is on the 15th. I'll probably have 1 or 2 seats that I'll open up to you guys. So keep an eye out for that. Outlier. See you guys later.